On April 14, 2024, a single anonymous wallet executed a trade on Polymarket. In under 2 seconds, it bought both yes and no tokens in the same market, each for under 2 cents. When the market resolved, that wallet collected $58,983, risk-free. That trade was not a lucky guess. It was mathematics, and it was not alone. Between April 2024 and April 2025, a small group of automated wallets extracted $39.6 million from Polymarket, not by predicting the future, not by knowing something others did not, but by exploiting a simple mathematical rule that the platform's own prices were violating, sometimes hundreds of times per day. This is the story of that rule, the math behind it, and why almost nobody saw it happening. To understand what happened, we need to start with how prediction markets actually work. Imagine a simple question. Will it rain tomorrow? On a platform like Polymarket, anyone can trade on the answer. Here is the key mechanism. When $1 enters a market, the smart contract mints exactly 2 tokens, one yes token and one no token. Together, they always add up to exactly $1. That is the fundamental invariant. No matter what happens, one of these tokens will be worth $1, and the other will be worth 0. The price of a yes token tells you the market's implied probability. If yes trades at 60 cents, the crowd believes there is roughly a 60% chance the event will happen. The no token automatically trades at 40 cents because the two must sum to $1. These tokens trade on an order book, just like stocks. Buyers place bids, sellers place asks, and when they match, a trade executes. On Polymarket specifically, this happens on the Polygon blockchain, with trades settling in about 2 seconds. Now scale this up. In 2024, Polymarket ran a market on the U.S. presidential election that processed $3.7 billion in total volume. On election eve, Trump yes tokens traded at around 58 cents. The polls had it closer to a coin flip. The market turned out to be right. But here is the critical detail. The $1 invariant is enforced at the minting layer. On the trading layer, where thousands of people are placing orders independently, the prices can temporarily drift. Yes might trade at 55 cents while no trades at 43 cents. That is only 98 cents. And that 2-cent gap is where $40 million came from. Let us make this concrete. Imagine a market with 3 possible outcomes. A is priced at 30 cents, B at 35 cents, C at 30 cents. Those prices should add up to $1 because exactly one outcome will happen. But they add up to 95 cents. Watch what happens if you buy all 3. You pay 95 cents total. When the market resolves, no matter which outcome wins, you hold a token worth exactly $1. You just made 5 cents with 0 risk. Guaranteed profit. No prediction required. It works in reverse, too. If the prices add up to more than $1, say $1.05, you can sell the entire basket. You collect $1.05 now, and when the market resolves, you owe exactly $1. 5 cents profit, again with 0 risk. This is called a Dutch book, named after a centuries-old gambling concept. The mathematician Frank Ramsey formalized it in 1926, and Bruno De Finetti extended it in 1937. The rule is devastatingly simple. If the sum of all prices in a market is less than 1, buy everything. If it is greater than 1, sell everything. The profit equals the distance from 1. Formally, for a market with outcomes 1 through n, let P sub I be the price of outcome I. An arbitrage opportunity exists whenever the sum of P sub I does not equal 1. The guaranteed profit per dollar is the absolute value of that sum minus 1. On Polymarket, this happens constantly. Prices drift apart because thousands of traders act independently. And when they drift far enough, automated bots detect the gap, execute a basket trade in a single atomic transaction, and pocket the difference. The entire cycle takes less than a Polygon block confirmation, about 2 seconds. In May 2025, a team from IMDEA Networks and King's College London published a remarkable paper. They analyzed 86 million bids placed on Polymarket over 12 months and mapped every single arbitrage trade that occurred. The total, $39.6 million. But the real surprise was not the amount. It was where the money came from. Look at this breakdown. Nearly all of the profit, over 99%, came from the simplest possible strategy, buying yes and no tokens within a single market when their prices drifted apart. The buy-no strategy alone accounted for $17.3 million. Buy yes added another $11 million. And what about the sophisticated cross-market arbitrage, the kind where you exploit logical dependencies between different markets like who will win the election and who will win Pennsylvania? That generated just $95,000, under 0.25% of the total. The expected sophistication turned out to be almost irrelevant. The paper identified the top-performing wallets. Number 1 earned $2 million across 4,049 trades, averaging about $496 per trade. But wallet number 4 is more interesting. It earned $768,000 from just 211 trades. That is over $3,600 per trade, suggesting a very different approach: selective, high-conviction execution rather than constant scraping. Perhaps the most striking finding: the researchers estimate that only about 1% of detected arbitrage opportunities were actually exploited. The remaining surface area is enormous. The math is simple. The execution is not. But wait, why should prices in a prediction market actually reflect the true probability of an event? The answer goes back to 1785, when the Marquis de Condorcet proved something remarkable about group decisions. His jury theorem says this: if each person in a group is right more than half the time, even slightly, then as the group gets larger, the probability that the majority is correct approaches 100%. Watch. With just one voter who is right 51% of the time, majority accuracy is 51%. With 51 voters, it jumps to 56%. With 501 voters, it reaches 67%. The curve keeps climbing. It converges to certainty. This is not just theory. The Iowa electronic markets, the first academic prediction market, ran for over 2 decades. Researchers found that its prices beat traditional polls 74% of the time across nearly 1,000 polls in U.S. presidential elections from 1988 to 2004. Polymarket continued the pattern. In the 2024 presidential election, the market priced Trump at roughly 58 cents heading into Election Day. Most polling aggregators had the race closer to a coin flip. The market was right. But here is the paradox. If markets are perfectly efficient and prices already reflect all available information, then there is no reward for being informed. And if there is no reward, nobody gathers information. And if nobody gathers information, prices cannot be efficient. Economists Sanford Grossman and Joseph Stiglitz proved this impossibility in 1980. The resolution is that markets are never perfectly efficient. They are partially efficient. And that partial inefficiency is exactly the gap where our $40 million lives. Suppose you have an edge. You believe an event has a 55% chance of happening, but the market is pricing it at 40 cents. That is a profitable bet. But how much of your bankroll should you risk? In 1956, John Kelly Jr. at Bell Labs solved this problem. He derived a formula that maximizes the long-run growth rate of your wealth. It is called the Kelly Criterion, and it is elegant. The idea is to maximize the expected logarithm of your wealth after each bet. For a binary bet with win probability P and net odds B, the expected growth rate G of F, the fraction you wager, has a single peak. Bet too little, and you leave growth on the table. Bet too much, and you cross the peak into negative expected growth. There is exactly one optimal fraction. The Kelly fraction is F equals B times P minus the quantity 1 minus P, all divided by B. It has a beautiful interpretation. The numerator is your expected edge. The denominator normalizes by the odds. Let us apply it. A yes token trades at 40 cents. You estimate the true probability at 55%. The net odds are 60 divided by 40, which equals 1.5. Kelly says, bet 25% of your bankroll, not more, not less. 25% maximizes your long-run growth. But there is a catch. Full Kelly is aggressive. Simulations show that a full Kelly bettor routinely experiences drawdowns of 60% or more. Your bankroll can halve before it doubles. In practice, professional traders use what is called fractional Kelly, typically betting 1/2 of the Kelly amount. You capture roughly 75% of the optimal growth rate, with dramatically less variance. It is the difference between mathematically optimal and practically survivable. But not everyone on Polymarket was running arbitrage bots. Some were making enormous directional bets, and no one bet bigger than a French trader known as Theo. Theo operated through at least 11 wallets with names like Theo 4, Freddy 9999, Princess Caro, and Michi, all funded from a single exchange account. His initial position was around $30 million on Trump to win, spread across the presidential race, the popular vote, and key swing states. What made Theo different was his edge. He commissioned a private poll from YouGov with a crucial twist. Instead of asking people who they planned to vote for, it asked who their neighbors were voting for. This social desirability correction is designed to detect shy voters, people who support a candidate but will not admit it to a pollster. Theo's poll detected a significant shy Trump effect that public polls were missing. Armed with this private information, Theo scaled his position from $30 million to roughly $80 million. In Kelly terms, he had estimated a higher probability than the market was pricing, and he sized his bet accordingly. The result? Bloomberg initially estimated $48 million in profit from 4 wallets. Blockchain analytics firm Chainalysis later identified all 11 wallets and revised the estimate upward to approximately $85 million. One trader, one private poll, one mathematical edge. But there is a darker side to this story. A Columbia University study in November 2025 found that roughly 25% of Polymarket's historical trading volume may be wash trading, accounts trading with themselves to inflate apparent activity. In December 2024, that figure peaked at around 60% of weekly volume. The likely motive? Speculation about a future platform airdrop. Manipulation is another concern. Theo's trades were legal, but they moved the market by several percentage points. When you can shift a prediction market's implied probability with enough capital, the line between informed trading and manipulation becomes blurry. Nate Silver himself called the October 2024 Trump spike a larger swing than the evidence justified. The regulatory story has been turbulent. Polymarket paid a $1.4 million fine to the CFTC in 2022 and banned U.S. users. The FBI raided its CEO's apartment in November 2024. But by mid-2025, the DOJ closed its investigation without charges. And in October 2025, ICE, the parent company of the New York Stock Exchange, invested up to $2 billion in Polymarket at a valuation of roughly $8 billion. The prediction market went from regulatory outcast to institutional asset class in under a year. And there is one final mathematical irony. The no-trade theorem, proved by Milgram and Stokey in 1982, says that if all traders are perfectly rational and share common prior beliefs, then no purely speculative trade should ever occur. The fact that $40 million in arbitrage persisted for an entire year is itself mathematical proof that markets are not fully rational. And that is exactly why they work. Here is the thing about arbitrage. It is self-correcting. Every bot that exploits a price gap makes that gap smaller. Every trader who enters the market makes it more efficient. The $40 million window that existed between 2024 and 2025 is already narrowing. But the mathematics will not change. As long as humans trade on beliefs rather than proofs, prices will drift from their theoretical values. And as long as they drift, someone with a calculator and a connection to the blockchain will be there to collect the difference. The real question is not whether prediction markets can predict the future. It is what it means that you can buy a piece of the future for less than it is worth. References and citations are in the description below.